Ladies and gentlemen, good day and welcome to Aptus Value Housing Q1 FY2024 results conference call hosted by Dolat Capital. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Mona Ketan from Dolat Capital. Thank you and over to you, ma'am.
Thank you, Yusuf. Good evening, everyone, and welcome to the earnings conference call of Aptus Value Housing Finance India Limited to discuss its Q1 FY24 performance. We have with us the senior management from Aptus to share industry and business updates. I would now like to hand over to Mr. Anandan, Executive Chairman of Aptus, for his opening comments, after which we can take up the Q&A. Thank you and over to you, sir.
Thank you. Ladies and gentlemen, good afternoon to all of you. I am Anandan, Executive Chairman of the company. I welcome you all to the conference call to discuss the company's performance for the quarter ended June 23. I have with me Mr. P. Balaji, MD, Mr. C.T. Manoharan, CBO, and Mr. Vijayan, John Vijayan, CFO. The financial results and the investor presentations are available on the website and is being posted in the stock exchange as well as our company. I hope everyone had a chance to look at it. Aptus, as you are aware, believe in growth with the due importance to the quality as well as the quality of the loan book and in financial metrics. Very happy to record that Aptus had a decent first quarter of FY24. Sharp focus, customer centricity, deep penetration in third markets along with appropriate tech support have enabled the company to achieve a good growth. Going forward, we will continue to focus on some of the key strategies, namely, we will continue to our growing disbursements and loan book. We will grow the disbursements and loan book both in HL, housing loan, as well as in the SME loans. Considering the large headroom available in the low and middle income segments, particularly in Tier 3 and Tier 4 cities. Increasing penetration in the existing geographies by opening new branches and commencing operation on a continuous basis in the adjacent stage, because we have started already in Orissa and we plan to start in Maharashtra as well. Strengthen analytics and digital adoption. Again, about 14% of our business in Q1 24 has come from construction ecosystem app, that's our own app, and customer referral app, and social media leads. Our focus shall continue be to increase the leads through the channels. In addition, the physical branch network, and continue to focus on productivity, collection efficiency, OPEX, and in cost of funds as well. Our net worth, as you know, stands at around 3,400 crores, indicating robust capital adequacy. This, coupled with good support from NHB, National Union Bank, banks, DFI on the borrowing side, and with strong on-ground demand for both home loans and small business loans, gives us confidence to pursue strong growth in the years with sustained profitability. I would now hand over the line to Mr. P. Balaji, MD, to discuss various business parameters. Thank you.
Thank you, sir. Good afternoon, friends. As on 30th June, the total live customers were over 112,000, representing a growth of 27% year-on-year. Total number of branches were at 231. 7 more branches have become operational as we speak. These branches are mostly in the states of AP and Karnataka. Employee count was at 2,584. Major performance highlights are AUM growth by 29% year-on-year to 7,123 crores. Disbursements increased 23% year-on-year to 646 crores. Spread was at 13.29%. OpEx to assets were at 2.55%. PAT at 142 crores had a growth of 20% year-on-year. ROA and ROE was at 8.21% and 16.93% respectively. Now coming to the asset quality, collection efficiencies dropped marginally to 99.52% in the quarter, which is somewhat seasonal as it is applicable to most of the NBFCs in the first quarter. This has resulted in our 30-plus BPD and GNPA increased marginally by around 0.37% and 0.14% respectively. This will be improved and restored back to the collection levels of more than 100% in the ensuing quarters. Net NPA was at 0.97%. Provision coverage has been consistently maintained at 1.06% as on 30th June. We are carrying a total provision of around 76 crores, and this, when computed as a percentage of NPA, works out to a coverage of 82%. Outstanding restructuring book was minimal at 0.58%, and the behavior of this book is on par with our normal book. Coming to the borrowing, we have well-diversified borrowing. Of the total borrowing, 50% are from banks, 28% from NHB, 9% from NCDs, issued to IFC, mutual funds and NBFC, and the balance in form of securitization. We enjoy a rating of AA- both from ICRA and CARE. We have sufficient on-balance sheet liquidity of 897 crores, including an undrawn fraction of 400 crores from NHB and from banks. As on 30th June 2023, our net worth was at 3,400 crores. Thank you all. Now with these remarks, I open the floor for the question and answer session.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, to ask a question, you may press star and 1. We have our first question from the line of Ms. Mona Ketan from Dolat Capital. Please go ahead. Ms. Mona, your line is unmuted. Please go ahead.
Yeah, hi, sir. By the time the question queue lines up, I'll just take a few of them. So firstly, going by the low credit cost in an environment where you're seeing slightly higher NPA levels and, stable PCR levels across your overall ECL versus the stage 3 provisions, were there good recoveries during the quarter that helped the low credit cost?
Actually, if you look at the provision increase as per our ECL table, it is around 4.5 crores or 4.2 crores. From 71 crores, we have increased it to 75.51 crores. But if you look at the P&L debit, it is around 2.5 crores, which means there is a good recovery from the ones which have been earlier written off. So that's the reason why the difference is there, and we have recovered almost 1.8 crores there.
Actually, just to add to Mr. Wadhwani said, actually, if you look at our pre-COVID year, FY19, FY20, FY21, we've always had a very low NPA and hence very low credit cost as well. Only FY22 and 23, our credit cost has gone up primarily to provide more. We have really gone for a very comfortable level and very high level of provision. But having made that, that's where we currently carry a cumulative provision of about 70 and odd crores. But that very well covers our requirements in terms of for the NPA and others. So going forward that way, the high level of provision that was required on account of COVID and the consequent increase in NPA may not be required, at the same level. So in other words, while it is true that when compared to FY23 or 22, first quarter credit cost is lower, but going forward also this trend will be more around this level. In fact, in the pricing, we did provide credit cost of up to 0.5%, but actually ours will be much lower than that going forward.
Got it. And just referring to the rise in stage 3 levels this quarter, so where could we end the year at? Could we see a similar trend like last year where stage 3 increased in Q1 but then moderated over the course of the year?
I think that's what will happen. See, if you look at our earlier NPA as of June 22, it was around 1.75%. It was reduced to 1.15% as of March. So, but we are starting this year with a much lower NPA as compared to June 22. But this again will be reduced and it will be brought down to at least to the levels of the last year, basically at least at 1.15%. But efforts are on to reduce it below that as well.
Sure. I'll just come back in the queue. Thank you.
Thank you, Manoj.
Thank you. Before we move to the next question, reminder to the participant, anyone who wishes to ask a question may press star and 1. Next question is from the line of Bhuvnesh Garg from Investec Capital. Please go ahead.
Hi, sir. Thank you for the opportunity and congratulations for a good set of numbers. Sir, I have a question regarding our cost of fund. So we have seen our increase in cost of fund during the quarter. So how much further increase do you expect in cost of fund? And then how our NIM would play out in that scenario in rising cost of fund? Yes.
During the quarter, we have got sanctions worth 740 crores. As that, we have drawn some and we have still 400 crores is yet to be drawn. If you look at the various kind of interest rates that we have contracted with, basically in the housing finance company, we have contracted at around 8.1 to 8.2% of around 400 crores. This is again a fixed interest rate loan, which is going to be there for the next 5 years. So that is on the housing finance side. And for the NBFC, it is slightly more by at least 0.25 to 0.5%, where we had raised money at around 8.4 or 8.5% in the NBFC to the extent of 240 crores. So this is the levels at which we are borrowing now, and we are negotiating hard with the funding agencies for getting this done. But obviously, it is getting in the range of 8.2 to 8.5%. But what will happen going forward is during the third quarter, NHB is likely to sanction some money. So that will be at a lesser rate of interest. With the result, the cost of borrowing is likely to remain for the year at around 8.3%.
Just to add the other part of the question in terms of NIM, it is true that our NIM has slightly come down in Q1, primarily because of the 250 basis points increase that's happened in the interest cost during the last couple of, we are really increased our EMIs only in the fixed loan contract, that's about 23%. Sorry, variable loan contract, that's about 23% of our portfolio. And we have not gone for any increase at all on the, on the other segment of the portfolio, and we have really absorbed everything. But we also believed in the philosophy that given our current lending rates and margins, we were not wanting to be ahead of the cost increase. But having waited for a reasonable time, now we have decided to revise our EMI to incorporate the higher interest cost, and we have revised our EMIs to take care of another 50 basis points increase in our lending rates. So in other words, on the overall terms of 250 basis points, we have really gone for about 50 basis points on a portfolio of only 23% effective November 23 and November 22, and we are now planning to. We have from 1st of August we are increasing by another 50 basis points on the rest of the portfolio. This is really to cover the entire 250 basis points that happened in the interest cost in the past.
Sure. And this 150 bits, when was this price hike taken?
I didn't get your question. What is that?
150 bits yield increase you are saying. So in which month it was taken?
50 basis points increase was done in November 22. Okay. And the current increase is going to happen from 1st of August.
1st of August. Fine, sir. And secondly, sir, on our bounce rate, if you can mention what was the bounce rate for the quarter and how it has moved QOQ or YOY.
Bounce rate, at the time of COVID, it inched up to around 26-27%. But after that, it is getting consistent at around 20%. But the kind of customers we serve, this 20% bounce are predictable and it is in line. And again, this 20% bounces also is not because the customers don't have the ability to pay the money, but they have these weak banking habits. So because of that, this 20% bounces are coming. Even after this 20%, almost 15% or 85% of that 20% is getting collected by way of digital means, either by way of Bharat Bill Pay or through UPI payments, which means the 5% of our total collections is only by way of cash.
Got it. And sir, about our credit cost guidance. So if I heard it correctly, so you said that the credit cost that we saw for the quarter, it will remain at the same level for going forward. Is my understanding correct, sir?
Yes.
Okay. So then that comes out to be only 15 bits then. For the quarter, we had around 15 bits credit cost.
What will happen is we are having this provision coverage of 1.06%. If you look at my breakup, 76 of this 76 crores, as per the ECL requirement, the requirement is only 42 crores. So the balance 33 crores is the management overlay which we are carrying in our books. So this 1.06% is likely to be maintained over the quarters, which means the increase in loan book to that extent will be providing at 1.06%. That's it. So on the overall book, this 1.06% will be maintained. So whatever is the differential, that debit will come into the P&L account.
Got it.
Our level of the NPA, not only NPA, but even the 60-90 also is fairly at a low level. And while there is scope for improvement in our soft bucket collection in terms of 0 to 30 or 30-60, but 60-90 and NPA levels have really come down reasonably. And we are also in terms of putting a lot of collection effort to improve that further. So going forward, our credit cost will be, around that, and best possibly go up to maybe about 0.25%, for 25 basis points. That's about it.
Got it. Very clear. Thank you and all the best, sir.
Thank you. A reminder to the participant, anyone who wishes to ask a question may press star and 1. Next question is from the line of Renish from ICICI. Please go ahead.
Hi. Congrats on a good set of numbers. Again, just a follow-up on the price hike. So if I heard you correct, we are increasing our rates by 150 basis points from August 1st?
Not 150. It is 50 basis points only, not 150.
Okay, it is 50 basis points from 1st August.
From 1st August. Yes, Renish.
Got it. And so secondly, again on the ECL provisioning and the net P&L credit cost, so this quarter it was 15 basis point. So for rest of the 3 quarters, you are expecting this to remain at 25 basis point, is that right? Or
yes, it will be around that, yes.
For the rest of the 3 quarters, right?
Yes.
Okay. And on the full year basis, what is our AUM growth guidance, sir, for 24?
We have been guiding the market at 30% loan book growth. That stays put. That will be there.
Okay. And with similar AUM mix?
Even in the first quarter, while our disbursements are slightly lower, around 23% or so, but our loan book is grown even in the first quarter by about 29%. So, for the full year, we are confident of around 30 plus going forward.
Got it. And AUM mix ideally will remain same, or there will be any one segment?
What is happening is, if you look at the total consolidated book, 59% is home loans, which we have to bring it at least up to 60% on the housing finance company based on the total assets. So to that extent, there will be a small change in the housing loans to the other loans. But again, if you look at on a consolidated basis, we have an NBFC where there is actually no limit for doing that business. So to that extent, it will get evened out, but it will more or less be the same. So only thing is this housing loan percentage will slightly go up.
Got it. And since the there will be only a percentage point of increase in the home loan, the book mix change will not have any impact on the yields, right? I mean,
yes, it will not.
Got it. Okay, that's it from my side. Thank you and best of luck, sir.
Thank you, Ramesh.
Thank you. A reminder to the participant, anyone who wishes to ask a question may press star and 1. We have our next question from the line of Ms. Mona Ketan. Please go ahead.
Yeah, hi sir. I just have a few additional questions. So firstly, on the loan mix, if you look at the loan mix slide, the SBL book, which is about 1260 crores, it grew by 29% Q on Q, the NBFC book, which is, I'm assuming, largely constitutes of SBL. Yet, if I look at the share of the same in the Concall mix, it's about 21%. So, just wanted to understand, I'm assuming the entire NBFC book is SBL loans only. Is that correct?
I'll explain you, Mona. What is happening there is, from this quarter onward, what we have done there is, if you look at the non-housing loans per se, there are two categories. One is the quasi-home loans, which we have explained in the past. The other one is some of the loans, it's actually the LAP, which is more akin towards the SME, the small business loan types. So what is happening there is, those kind of loans we have started booking in the NBFC. Okay. So there is also small business loans that get booked under the NBFC. There is also this LAP, which is more towards small business loans that gets booked under the NBFC. So to that extent, which was earlier booked under the housing finance company. So that's the whole reason why this has got an increase in the loan book of 29%, considering the lower base there.
Okay, so essentially the growth in LAP was pretty substantial, which comes in the quasi-HL.
Yes.
In the Concall profile.
Yes.
Okay. And if I look at the, HL growth, HL book growth, it seems to be, okay, no, that's fine. Got it. So where would be the 1 plus DPD for us as on June?
As of March, it was around 8%, right? Now it has gone up to 8.5% because this 0.37 plus 0.14 has got into this.
Sorry, come again on the number?
8.5%.
8.5%.
Yeah.
Okay, and just to reconfirm the rise in PLR in your case, so the price hike in all has been about 100 bits, 50 bits in November and 50 bits in 1st August.
Yes, and that too on...
No, let's extend that. The first 50 basis, actually in all we have made only an increase of 50 basis points only. Of the portfolio, 23% of the portfolio, we have implemented the 50 basis point increase from November 22. Yeah. Of the balance, 100 minus 23, of the balance, we are increasing by another 50 basis points effective 1st of August. So it is not 50 plus 50, 100, no.
Okay.
50 only.
Okay, so this is the fixed rate book where you can actually increase the, you have the provision of increasing the yield. That's what is happening?
No, we have the clause in the agreement to get this increase done.
Right.
Not a problem, yes.
And that's what you are exercising?
Yes.
Okay. So in all, there will be only 50 bits for the overall book. The pending 70%, 80% of the book will be inculcated, the 50 bits.
Right, yeah.
Okay, now that's pretty clear. Got it, sir. So, just one final thing. You touched upon this, regulation around HFC having, 60% of assets which needs to be towards individual housing loans. So, are we already meeting this target, which is required by end of FY24?
Yeah, as of June, we are at around 58% there in the housing finance alone, if you consider the total asset.
Okay.
So, 2% is easily achievable. We are working towards that to get this done.
Got it, sir. I'll move back to the queue. Thank you.
Thank you. Next question is from the line of Manoj Oberoi from Yes Securities. Please go ahead.
Yeah, sir. Hi, this is Rajiv. Congratulations on healthy numbers. So just reconfirming, have we taken 50 bips rate hike even for SBL?
Yes.
Okay. And in terms of geographic mix, when I calculate, growth rates, incremental growth rates, Telangana has seems to have, witnessed some slowdown in this quarter. Would that be right, sir? And any reason for that?
Telangana, why there is... One second, Rajiv. What is the question? Telangana, slowdown.
No, actually, no. If you really look at the loan book, we had a very strong disbursement in Andhra, followed by Telangana, and followed by, Karnataka, and then Tamil Nadu in that order. And if you really see the, Telangana, actually, in percentage, Telangana, it is really, the loan book growth, it's not here, it's a breakup only.
1 second, Rajiv.
Actually, going forward, we are really looking for very good growth in Telangana. Currently, we have about 35 branches, and we are planning to add another 15 branches in Telangana. Just to give you a number, actually, in Telangana, between, let's say, FY23, we had a loan book of about 703 crores. First quarter FY4, it is 1,003. There is an increase of 43% in the loan book in Telangana. 48% increase in the loan book of Andhra. And so Telangana is we had in the first quarter, YOY, and even for that matter, Q and Q also, YOY growth is 43% in Telangana. I don't know where you got the number which shows lower than.
No, I'm saying the rate of growth sequentially seems to have slightly softened. So YOY growth is pretty strong, I agree. So I was just trying to...
No, actually, in the investor presentation, I'm just reading out 2280, 21400, 22600, 23900. Now it has gone up to 1003 crores. So in other words, there is year on year very strong growth coming in Telangana. In fact, we are expecting this to continue and 1,000 crores also to go up substantially going forward as well.
Got it, sir, clear. And sir, my question is to Mr. Anandan. So, sir, how do you see your association with the company, going ahead? Because your term is getting over as an executive chairman in December 24. Suppose that, how would your association with the company be? How actively, and in what position can you be involved, with the operations of the company?
I'll answer it in two parts. One is that I will be in executive responsibilities from now, that is, as on date, to December 24. That's a little over 1 year and 4 months. So I'll be here in the executive position very much. Okay. And of course, I'll be focusing more in terms of the future strategies and more in terms of how do we really take this company forward from the current level of 7,000 crores loan book to, let's say, 15,000 crores or 25,000 crores. And what do we do in terms for that to achieve? What do we do on the product side? What do we do on the geography side? What do we do on the IT side? What we do broadly and and what is the kind of HR talent that we have at the macro level? So that is what my focus will be. Because prepare this organization to to the next level. That's what I will be largely focusing on in this year and 4 months or so. So as far as after December 24, it is something we need to review. I don't have a agreed or cleared or approved position or as on this day. That, as you know, the board will deliberate and take a decision maybe at least 6 months earlier than my December 24. I'm talking about that is too early. But then, so this is precisely, I will be fully, involved into in the executive position till December, and at least 3 to 6 months before that, we will explain to in all concerned what will be my role, if at all I have a role, after December 24.
Got it. But sir, post December 24, by virtue of your shareholding and being a founder, you can remain on the board, right?
You can remain on the board. No, that my intention is to remain on the board. Okay.
Okay.
They have to decide whether they want me to be there on the board or not.
Got that.
But strategic guidance will be there. But as you know, as per the recent SEBI guidelines, all of us, including there's nothing like non-retiring directors. Everybody has to really get re-elected every 5 years, including the promoters.
Got it. So your intention is clear, then the board will decide. Got it. Yeah. And just last thing on the distribution expansion plan, if you can just kind of elaborate how many branches, where the branches will be added in the next couple of years.
As of June, we have this Manohar?
Hello?
Continue.
As of March ending, we had 231 branches. And as of today, we have added another 7 till now. That is 231 plus 7. We are at 238 now. And by September, we will be adding another 10 more. That is, so 238 will become 248. And after that, we will be adding another 10. So by end of March 2024, we will be around 260, 265 plus. And later we will be, third quarter second quarter itself we will be entering Maharashtra state, and we will be trying to expand in a systematic manner in that state also. We have already done that in Odisha. So we have 2 branches in Odisha which will go up to 5 or 6. And by September we will be entering Maharashtra with 2 to 3 branches, and then we will see how to take it forward. So as far as distribution network is concerned, we will get 260 plus by March 24.
So in addition to physical distribution, a lot of effort and investment is going on, people and the money investment on the digital side in terms of how to, strengthen our app, our customer app and our ecosystem app, and also through the other social media networks. How to enhance, particularly focusing not only the new customers, but we would want to focus on our existing customers who have already crossed over 110,000 customers. And we see a lot of opportunity to mobilize business through our existing customers as well, in addition to the branch network, both in the existing states and the newer states.
Yes, sir, clear. Thank you so much and best of luck.
Yeah. Thank you. Next question is from the line of Kushan Parekh from Morgan Stanley. Please go ahead.
Hi, sir. Thanks for taking my question. I had two questions. The first question is around our loan spreads. So we've been seeing loan spreads declining over the past few quarters, largely on higher funding costs. And like we guided earlier in the call that broadly FY24 costs should be settled at around 8.3, 8.4% for the full year. So just trying to understand, with the PLR hike that we are taking now of 50 basis points, how should we think about loan spreads? Should loan spreads settle at current levels, or should we see them see a slight increase going forward?
Consequent to this increase of this 50 basis points, which is going to be effective from 1st August, we are very confident of going back to the spreads of as of March. So that is the thing, and obviously it has to be supported by the cost of funds, which is to be maintained at around 8.3%. With that in place, I think with this increase of 50 basis points for the rest of the portfolio, I think we are very confident of getting to the spreads of around levels of March.
Actually, there are two elements. One is at the NIM level, and second is at the ROA level. At the NIM level, as I mentioned, we of the 250 basis points increase in interest rate, we are really going for a maximum increase of 50 basis points. And that will not, and we do have a certain amount of pricing power, not only us, including our competitors also. We do have certain amount of pricing power in this market segment. So 50 basis points should not impact us in terms of our loan disbursements and growth. And that will help us to, maintain at the NIM level spread. Second, in terms of ROA level, there could be some, reduction, change could be there purely on account of the leverage. Because as we really, more funding comes out of borrowing rather than equity, and the gearing level goes up, ROA, will currently run much higher than 8. It will come down a bit, but then that will only, as you know, very positively impact our ROE. And as you must have observed, our ROE has already moved up from 14.45 in FY22 to 16.34 in FY23. And even in first quarter, it has moved up to further 16.93. So in other words, the small reduction in the ROE, consequent to the leverage, will only have a positive impact in terms of shareholder return.
Sure, sir. Understood, sir. Thanks for your response. Just one more follow-up on this question. Basically, on our incremental yield for both housing, non-housing loans, have we increased yields for them as well by 50 bits?
See, for the non-housing and the small business loans, we have increased it. And even for the housing loans, already the 23% of the loan book, we have already increased it. So for the fixed rate, we are not increasing. Yeah.
Okay. This is for incremental new loans that we do, right?
Yes. For the variable book, it's retrospective. For all the live customers, it is being done. For the non-housing loan and the small business loans, it is for the incremental book.
Okay, understood. Thanks for that. And just one last question from my side. On the employee cost, we saw QOQ decline from 4Q to 1Q. If you could just explain that, elaborate on that a little bit, and how should we look at employee costs going forward?
See, if you look at our disbursements Q on Q, it is slightly reduced. There is a small decrease in the volumes which we have done in the first quarter, basically because of the seasonal impact that is there in quite a few NBFCs. After March and April, there is a small dip in the disbursements. Because of this reduction in the volumes, the variable pay which are payable to the sales officers and the feet on street has reduced, and that has resulted in this savings in the costs as compared to the Q4 of FY23. So going forward, this cost will be there as long as the volumes are picking up. So it can go up to that extent. But the increments which we have given has already got priced in. So to that extent, there will not be any increase. But variable cost impact will be there, but that will be offset by the increase in the volumes.
Actually, at the macro level, we will continue to be, one of the organization with very, very efficient OPEX. And our operating expenses are one of the, lowest in the industry, as you're aware. The question is in terms of manpower, yes, particularly customer-facing jobs like sales officers and the collection officers. Now, there it is largely linked to, particularly sales officers largely linked to the performance. There's a variable component important. And it so happened in the month of April and May, our disbursements are lower. Actually, our disbursements started picking up in June itself. In fact, in July, our disbursements we have really crossed almost over 30% already in July. So if you look at our manpower cost in July, it would have improved further. So otherwise, particularly there is a variable component, particularly to the sales officers and field level officers, and that happened to be simply linked to the disbursement. And April, May, our disbursement slightly lower. Again, it is a normal phenomenon. First quarter and the first month 1, month 2 has always been slightly lower, but it tends to pick up from third month itself, June itself. At July, we have come back to normal. Cost also will come back.
Understood, sir. Thanks very much. That's all from my side.
Thank you very much. Ladies and gentlemen, in order to ensure that management is able to answer the question from all the participants, may we please request to keep your question to 2 per participant. Next question is from the line of Concall from Citigroup. Please go ahead.
Yeah. Hi. So firstly, with respect to this 23% of the floating portfolio is where we had revised the lending rates by 50 bips in November 22. So, and on the balance, 77% of the fixed rate portfolio, now lending rate is revised by 50 odd basis points from 1st of August. So is that understanding correct?
Yes. See, for the non-housing loans, not the 77%, Kunal, what is happening is 23% of the housing variable rates belong to the whole housing portfolio, where we have changed this 0.5% for all the live customers in November 22. Okay.
Yeah.
Now, what we are changing now is basically the non-housing loan and the small business loan for all the incremental customers, because these are fixed rate loans. As of now, we are not changing the earlier ones. So, all the incremental loans, 50 basis points increase for both the non-housing loan and the small business loans we are doing.
Yeah, so this incremental which is there, that's not for the 77%. In fact, it is only for the non-housing and the SBL, because I think maybe what we highlighted was for the balance we have increased it. But so it is only for the non-housing and SBL is where we are now revising it on an incremental basis from... Yeah. Okay, got that. And when we revised this 23%, by 50 odd basis points and the kind of yield expansion over last 4 odd quarters of almost like say 20 odd basis points, but there is no big change in the portfolio. Actually, when we look at it, almost like the portfolio is also steady across maybe home loans, LAP, small business loans. So then maybe what would have led to this kind of increase of 20 odd basis points in the yields? And now with this 50 bips kind of an increase, how should we see the overall yield movement? Yeah.
See, basically, as Balaji is explaining, on the overall basis, our HL is about 58% on a consolidated basis, and 42% is only the non-HL. So the entire non-HL of 42%, we will go for this 50 basis point increase effective first of they already implemented effective 1st of August. Now, on the 58 of home loan, we have already revised 23, the variable part of the home loans, 23% of the 58, we have revised it from November. And the balance we are not planning to revise.
Yeah. So got that. So when we look at it, maybe 23% and 50 odd basis points, that should ideally have at the 10-12 basis points of the positive impact on yields. Okay, so now that's where I am coming from. So there is almost like 20 odd basis points increase, but still there is no change
how this increase has come because of the small change in the product mix. Yeah, that's right. If you look at our September portfolio mix, the small business loan was, I think, 19%. This has gone up to 21% as of now. So there is a small change in the product mix that is helping us in getting a higher yield there.
Okay, hardly like 1% odd. Okay, so that's something which is helping.
Also, Kunal, the other aspect is that, our some of the fee earnings, particularly processability and all, it's somewhat, linked to the volume of disbursement. And it so happened in the month of April and May, our disbursements were slightly lower. But now it's come back to normal. So our fee income will get back, even in the month of July, it got back to the normal level. That will also help in terms of, our overall margins.
Okay. And how much would be the balance transfer for us in the pre-closure?
We have around 8% of the, first I will answer the pre-closure part. There's around 8% of our average loan book is getting pre-closed. Of that, almost 67 or 70% is out of own source, own funds from the customers. The balance 30%, which is around 2.3% or so, is getting transferred to the outside either small finance banks or some of the NBFCs. Loan transfer. Yeah.
Okay. So compared to 3 odd %, it's now down to 2.3 or so.
Yes.
Okay. And one last question on OPEX. So where do we see it? Would it come back to 2.75 odd % given?
Actually, our OPEX has been pretty good, it's almost all we are very well OPEX. If you really look at our OPEX, Kunal, if you really look at it, right from 19 to 3.67, 3.26, 2.7, 21, 2.5, 22, 2.75, little increase was there in 23, and now it is about 2.5. We will be, between the 2.5, 2.6%, but we will be one of the most efficient and because we fundamentally believe in a very high level of productivity of our people. And it's not because of low salary, because our attrition levels are not higher than others. In fact, it is lower. And our salary levels are compared much favorable with competition. But while our salary levels are good, but we ensure that they perform. So it's more performance related, we emphasize, and productivity related emphasize. So that is helping us to really, and also certain culture-wise, certain frugality will be there in not only us, in some of the companies kind of thing. So it will be, our OPEX will always be efficient and comparable, and it will be around, 2.6, around at that level, actually.
Yeah, so still compared to FY23, maybe 15 bips decline is something which we can anticipate.
Yeah, but if you really look at FY22, it is only 2.53.
True.
And and in fact, FY21, it was 2.7.
Kunal, if you are expecting 2.55 for the rest of the year, I think it might not be there because we are adding branches, which is around 30-35 branches. And to that extent, the salary cost and the other costs will be there, and we are also investing good amount of money in the technology. So it can land between 2.6 to 2.65. Yeah.
Okay, got it. Yeah. Thanks a lot. Yeah.
Thank you. The next question is from the line of Pranav Gupta from Ionius Alpha Investment Managers. Please go ahead.
Hello.
Mr. Pranav, your line is unmuted. Please go ahead.
Am I audible?
Yes, you are. Please go ahead.
Yeah, hi. Good afternoon. Most of my questions have been answered. Just a couple of questions. So one is on the optimum leverage that we think that the business can run at. Currently, obviously, our margins are seeing benefit from the capital that is there in the books, and over a period of time, we will see the leverage go up. But when we interact with rating agencies, what is the leverage that they are comfortable, with a business like ours? That's the first question.
So if you look at the leverage currently on the total balance sheet size, it is around 2.5 or something. If you look at the debt to equity, it is between 1.5 to 1. We are comfortable, and we are having discussions with the rating agencies, and normally the leverage is, they are comfortable with 5 to 6 times, which means debt to equity will be between 4.5 to 5. So we are comfortable, and we are also comfortable, and the rating agencies are also comfortable on this at these levels. But considering the process which we are making, so this itself to achieve, it will take 2-3 years time to get to that level. So we will be very comfortable with these levels, and the leverage is likely to be at around 5 to 6 times.
Right. And so consequently, let's assume that an optimum leverage of 4.5-5 times. Where do we see the impact on? How do we quantify the impact on margins that might flow in because of the leverage going up and the proportion of capital funding the book going down? How should one think about that?
No, actually, with the leverage going up, as we know, it will impact our ROE, return on equity, lot more positively. And as you know pretty well, it won't really impact at the NIM level, but it will impact obviously the ROA level. NIM will not get impacted because of leverage. ROA will get impacted because as the gearing level goes up, ROA may come down a bit, but it will impact very positively in terms of ROE that we are seeing already. And we are really working towards improving our ROE further. And to that extent, our leverage will help us.
If I understood what you said correct, if I understood what you said was that ROA would get impacted, but margins would not get impacted. Is that what you said, sir?
Yes.
Given that your proportion of borrowings will go up, logically margins should get impacted, even though the spread might not get impacted. That is the question.
The net interest margin, because NIM is really the play between the interest charge and interest expended. The percentage wise, NIM percentage will not change. But then you are right. Now when it comes to ROA, the finance cost will go up because of the higher level of borrowing and our leverage. So the ROA, return on assets, will come down a bit. But then that will precisely will result in there is a direct correlation, as you know, between the when the leverage goes up, normally ROE will go up, return on equity will go up. That's also what we are seeing it. For example, as I mentioned earlier, FY22 we had 14.5, and last year FY23 went up to 16.3. So in the first quarter we have moved up to 16.9. So, but from the shareholder's point of view, it will impact the higher leverage will impact a better ROE.
Sure, I'll take it offline.
You can call me, I'll explain.
Yeah, sure. Thank you.
Thank you. Next question is from the line of Varun, an individual investor. Please go ahead.
Hi, good evening. So just to carry forward the conversation that you were having with the previous caller, I hope that you guys are not planning to artificially bump up the ROE by distributing dividends as you guys did in the last year. Solely because, given the size of the company, the loan book, and the growth potential that the company has, dividends actually do not seem justified, right? It's better that the company invests the money back in the business rather than distributing it to the shareholders. So what is...
Sorry, we are very clear, in the sense that as a company, we would have a very clear dividend policy and, with certain purpose and, And dividend, as you know, will only be part of the profit that they make, and substantial profit will be left in the form of retained earnings for the company to support the company's growth. So definitely, we are not going for 100%, payout just to ensure our, our ROE. And we are not going to do the way, let's say, historically, where some of the other one company in the housing finance sector did go for a dividend distribution of 80%. We are not trying to do anything like that. Okay. So in other words, there will be a prudent dividend policy in place to pay part of the PAT as dividend. A significant part of the part of the PAT will also be left to support the growth.
Yeah, but that is contradicting as what you guys did last year, right? Where the EPS was 10 rupees and you guys paid out 4 rupees as dividend, which is 40% payout. And given the stage the company is in, a 40% dividend payout seems exorbitantly high.
No, it is your view, and we have considered all aspects in the board, and that was, as you know, that is the first year, and there is not only, there's a first year. So, you just watch for a year or two more, then our dividend policy will be a lot more clear. Just let's not go by just 1 year.
Yeah.
That being the first year, there could be some special dividend also one time.
But you understand from an investor's point of view, right? Even from a tax point of view, is not efficient for the investors because dividends for us are being taxed at marginal rate, which is 30%. We rather have our money invest. So we invest in a small cap company like yours because we want to see that growth rather than you distributing the dividends to us and we paying 30% tax on that. So it just seems very inefficient way of rewarding the investors.
So we are aware of the implications. We know what is the tax rate on dividend. We know what is the tax rate on capital application. And we know what is required. In the board, we have people who are very experienced, being in financial industries and other industries. And we will behave very responsibly. Let me assure you that we will behave very responsibly when it comes to dividend declaration.
Okay, thank you. That's it from my end.
Thank you very much. Ladies and gentlemen, this was the last question for the day. I would now like to hand the conference over to Ms. Mona Ketan for the closing comments.
Thank you everyone for joining us today. Thank you to the management for providing us with the opportunity to host this call. Over to you, sir, for any closing comments you may have.
Thank you. Thank you. And Mona Condole. Thank you.
Thank you, Yusuf, and thank you, Mona, for organizing this call. I would like to pay my sincere gratitude to all the analysts and investor friends who have taken time out of the busy schedule to listen to us today. Please feel free to contact either me or Sanan or Mr. Anandan as well for any doubts you have on the company or any information you require. And thanks once again.
Thank you very much. On behalf of Dolat Capital, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.